Are you tired of feeling like you're living paycheck to paycheck?
I need money.
Overwhelmed by financial jargon or unsure where to start? You came to the right video. Whether you're starting from scratch or looking to fine-tune your financial habits, this free financial literacy course will walk you through everything you need to know. Saving, investing, taxes, debt, credit, retirement, and more. Money is one of the most powerful tools you will ever have in your life. It can provide freedom, security, and opportunities, or it could be the source of stress, debt, and regret. The problem is most people were never taught how to manage their finances properly. Schools don't cover it, and banks and corporations profit from financial ignorance. This is not about getting rich overnight. It's about changing your mindset, understanding how money works, making smart money decisions, and setting yourself up for long-term success. This will be a long course, but every bit of it is essential financial knowledge, so you don't want to miss anything. Let's begin with saving money. There's many reasons why you should be saving money: to pay off debt, deal with unexpected expenses, to survive if you lose your income, pay for expected expenses and larger expenses, and to buy assets that grow your money for financial goals. Now, first, it's recommended you pay yourself first. Before spending on your needs and wants, put a portion of your income into savings. You'll need to make a budget in order to know how much you can pay yourself. Have an emergency fund of at least $2,000. This will cover most unexpected expenses like a trip to the vet or your car breaking down. Next, you'll want to grow your emergency fund enough to cover 3 to 6 months of bare bones living expenses in case you lose your income sources. It's best to keep your emergency fund in a high interest savings account. Separate but easily accessible. Automate your savings. Set up automatic transfers from your bank to your savings account so you can save without thinking about it. Saving only 10% isn't enough. If you want to be in better financial health, you'll need to be saving at least 20% of your monthly income. Avoid lifestyle creep. Just because you earn more doesn't mean you should spend more. This is the best way to increase your savings rate. Think of money as hours worked. Before making a purchase, ask yourself, how many hours did you have to work to afford this? It puts spending in perspective. Live below your means. Everyone has different income levels. You need to spend according to your income level and spend less than you make. Delay gratification. Delaying gratification is the ability to delay an impulse for an immediate reward to receive a more favorable reward at a later time, like buying a house or a business. Do a no-spend challenge. A no-spend challenge involves committing to avoid all non-essential purchases for a set period, like a week, month, or a year. You can only spend on necessary expenses like housing, groceries, transportation, and debt obligations. Yes, this means no takeout food, so go home and cook.
I have to restart my potatoes.
Be frugal and thrifty. Learn how to save money when spending money by cutting unnecessary expenses and reducing necessary expenses. Like, stop trying to impress people, buy used, buy generic, buy in bulk, shop around for utilities and insurance, meal prep, eat leftovers, and DIY for any maintenance, repairs, or items. For a full guide on how to save money on all expenses, check out the video up here or look for the link in the video description below. But before you do that, let's look into the next topic: budgeting. A budget is essential for financial success as a low-income earner, a high-income earner, or a business. A budget should include income, expenses, debt payments, financial goals, and sinking funds. A budget doesn't have to be restricting. It's just a plan for your money. Budgeting methods: the 50-30-20 budget. 50% needs, 30% wants, and 20% debt and savings. The zero-based budget. Every dollar you make is assigned, so you know where it all goes. The cash envelope budget. Create different envelopes for each category in your budget. Once the cash in the envelope is spent, you can't spend anymore. Reverse budgeting. Pay yourself first by saving money first and then spend the rest. Automate your budget. You can automatically pay bills, pay debt, and transfer money to savings and investments. Budgeting apps. Use apps like Monarch, YNAB, and Pocketsmith for a dedicated budgeting app. Some banks have budgeting tools included within their app, like Scotiabank, TD, Royal Bank, Tangerine, or Koho. Or find a free basic budgeting app in the App Store like Easy Finance. I find that manually filling in your budget may help you understand your spending more, which can help reduce spending. You can't improve what you don't measure. A budget shows you what money is coming in and what money is going out. So to better manage your finances, you need a budget. Reevaluate your budget monthly. You won't get your budget right the first time. You'll need to adjust categories till it lines up with your monthly spending. You will also need to include expenses that aren't part of your everyday spending, like birthdays, holidays, annual expenses, etc. Every month will be different, so plan for it. Sinking funds. This is a separate account and category in your budget that you will need to set aside money for things like Christmas or new tires. This way, the larger expenses won't mess up your budget. The next topic is all about car ownership. Yes, this gets its own section. Why? A car or transportation is usually one of your largest expenses in your budget. It's usually the second largest purchase of your life, and it's the most expensive depreciating asset you will ever buy. And most people will take out a loan to finance their purchase. Buying a new car is the worst financial decision anyone will make and is considered the #1 wealth killer. Ownership just isn't a car payment. It's the maintenance, insurance, fees, gas, parking, interest, and depreciation. If you take home $4,000 a month, but car ownership is $1,000, that's 25% of your monthly budget. And if you have a larger car payment or a longer commute, you could be spending even more. What's recommended? Only spend 10 to 15% of your budget on transportation related costs. If you must finance a car, it's recommended you finance a used car that's 5 or 6 years old so you don't have to pay for most of its depreciation. But realistically, you need to buy a used car with cash in order to keep your transportation costs low or use public transit. Have you heard of car hacking? This is when you buy fully depreciated cars for cash. Let's say $3,000. And since you got no car payment, you can put away $500 or so a month. After 1 year, you'll have $6,000 in the bank and a car with an extra 20,000 kilometers on it. If you bought the car for a good deal, it's very possible to sell again for $3,000 or maybe $2,000. So now you can buy an $8,000 to $9,000 car. Repeat the process till you get the car you want, fully paid off in cash. To keep transportation costs low, you can share a vehicle between two people like a partner or friend, or you can carpool and save on gas. Then consider your transportation needs. Do you need a luxury car? They tend to appreciate the fastest. Do you need a full-size SUV or truck? Gas, repairs, and maintenance will be a lot more. Do you need multiple cars? If cars are the #1 wealth killer, imagine having 2 or 3. If you want to learn more about how much car can you actually afford, check out the link up here or look for the link in the video description below. Now let's explore housing. Keeping a roof over your head is one of your biggest expenses. Whether you're renting or owning a home, it's recommended by many financial gurus not to spend more than 30% of your net income on housing costs. Home ownership costs include closing costs, principal and interest, maintenance, condo fees, property taxes, insurance, utilities like water, heat, and electricity. The sad truth is that many Canadians are spending 50% or more of their income on housing costs. To reduce housing costs, the best thing to do is to live with someone else, a partner, family member, a friend, or a roommate. House hacking. If buying a house, consider a 2-apartment house, live in one unit and rent out the other unit. The rent money can help you reduce your housing costs. If renting, sign a lease or a longer lease. It may be able to lower your rent. And be a good tenant. This may help you keep your rent from going up and negotiate a lower rent instead of you moving out. Choosing the right location. There's 2 things to consider here: housing costs versus gas costs. You'll need to do some math to see where it's optimal to live. Living on the outskirts of the city may have a longer commute, but you can find more affordable housing. Consider the size of the house. The bigger the house, the more it will cost. Not only the rent or mortgage, but also the property tax, the utilities, and the hidden costs buying things. The bigger the house, the more furniture you'll need and the more space you'll have to fill with crap. When I lived in a 1-bedroom apartment, I had very little possessions, but now I have a 3-bedroom house with a 24 by 24 garage and a lot more stuff. Should you rent or should you buy? Renting provides more flexibility, usually costs less, and has fewer responsibilities. Buying has a high upfront cost, usually higher monthly costs, and more responsibility. But with buying, you build equity, you'll have all the control of your house, and there is potential for appreciation. And technically, you start building equity immediately, but you don't build a whole lot in the early years of a mortgage because you're paying mostly interest, not principal. In the end, renting is better for someone who doesn't want to stay in the same spot, while buying a house is better the longer you stay in the same spot. 5 years is considered the break-even point, but everyone's situation will be different, so the best thing to do is use a rent or buy calculator and consider many of the other factors involved. If you're interested in buying your first house, there are several ways to aid in the process. The Home Buyer's Plan, which allows you to borrow up to $35,000 from your RRSPs. The First Home Savings Account, which allows you to reduce your taxable income and grow your portfolio tax-free. The Home Buyer's Amount, which can provide a non-refundable tax credit up to $1,500. And the HST/GHT New Housing Rebates, which offers a rebate for some of the taxes you pay. Home Equity. Home equity is the difference between your home's market value and the amount you still owe on your mortgage. Your home equity increases as you pay down your mortgage, but also if you make home improvements or by market appreciation. You may want to access this home equity to fund home renovations, consolidate high interest debt, invest in real estate or a business, cover major expenses like education or emergencies. Let's look at the different ways to access this equity. A home equity loan, home equity line of credit, a second mortgage, and a few other options like a cash out refinance. When you do this, you can replace your existing mortgage with a new, larger loan and take the difference in cash. This will usually be the lowest interest rate of all the other options. The next topic is debt management. There are two different types of debt, good debt and bad debt. Good debt looks like a mortgage, student loans, business loans, and investing with low interest loans. If the money you make from debt offsets the interest you pay, it's good debt, or if it provides long-term value. Bad debt is your credit card debt, car loans, payday loans, buy now, pay later, and personal loans. Good debt or bad, it's recommended to keep your debt to income ratio under 36%. Make at least minimum payments to all your debts, and if you can, pay more than the minimum. This will reduce interest costs over time. Paying off debt. The avalanche method, which involves paying off the highest interest debts first to save the most money. And the snowball method, which involves paying off debt starting from smallest to largest. Although this method may cost you more in interest, the smaller wins keep you motivated, so it ends up being more successful. Although high interest credit card debt should be prioritized. If you're able to get approved for another credit card, you could do a balance transfer to save on interest. The MBNA TrueLine offers 0% interest for 12 months. There's a 3% transfer fee, but it's better than 20%. If debt piles up and starts to become unmanageable, you need to take some action. Avoid taking on new debt, negotiate with lenders for lower interest rates, and seek help from a nonprofit credit counselor. They can help in many ways, including creating a debt management plan and debt consolidation. The next level of help would be from a licensed insolvency trustee who can help with a consumer proposal or bankruptcy. A consumer proposal reduces a portion of what you owe. You get to keep your assets. It only stays on your credit report for 3 years, and you have fixed monthly payments. Bankruptcy, this is the last resort when dealing with debt. Bankruptcy will eliminate most debts, is a quicker process, stops the calls but you lose your assets, damages your credit score for 6 years or more, and your bankruptcy payments may increase depending on your income. Debt relief scams. Beware of unregulated debt advisors that promise a quick fix while charging unnecessary fees for service they are not authorized to provide. The red flags are guarantees, upfront fees, pressure to act fast, and claims to erase bad credit. The safest option would be to speak with a licensed insolvent trustee. Now let's shift our focus to income. Income is the foundation of your financial life. How much money you bring in will ultimately determine how much you can save, invest, and spend. There's 7 types of income. Earned income, your job. Profit income, your business. Interest income, like a high interest savings account. Dividend income, like owning shares of a company that pays a dividend. Rental income, like a rental property. Capital gain income, like stocks that increase in value. And royalty income, like making music. The factors that determine how much income you bring in include career choice, education, skills, experience, network, and work ethic. Ultimately, the more value you provide, the more money you will make. When you get an education, you increase your specialized knowledge, skills, and credentials that make you more valuable. But not all industries pay the same, and getting an education can be a large investment of time and money. This is why it's important to do your research and consider return on investment and opportunity costs. And don't forget to include benefits like pensions, RRSP matching, health and dental, life insurance, and vacation and sick days. RRSP matching is when your employer contributes to your RRSP based on how much you contribute, often to a set percent of your salary. It's essentially free money that boosts your retirement savings. It's also important to understand demand and competition. Will you easily get a job, or do you have to travel for work? The growing in demand careers include healthcare, technology, finance, and engineering. Your performance at work should reflect how much you want to get paid, not how much you're getting paid now. This will increase your chances of getting a raise. Your employer may give you a raise of maybe 5%, but statistics show that switching employers can provide a 10 to 20% salary increase. Some people believe that taking a raise will cause them to make less money because they fear moving into a larger tax bracket will result in a lower take-home pay. However, this is a misunderstanding of how progressive taxation works. In reality, only a portion of income above the new bracket threshold is taxed at the higher rate, while the rest remains taxed at the previous rates. However, an increase of income may result in not qualifying or a decrease for certain government benefits. A degree isn't necessary to bring in good income. You also have skilled trades, sales, and the job that has limitless potential, self-employment, and business owners. When you work for someone else, you provide a company with value that's worth more than your income. But when you are self-employed, you can now leverage that value. You can make the majority of your income from your 9-to-5 job, but also consider what you do in your leisure time. To bring in additional income, you can get yourself a part-time job in the evenings or weekends, or start a side hustle like DoorDash, Uber, or dog walking. Or even better, start a small business like pressure washing houses or snow clearing. This may start off slow with minimal profits, but it can grow to eventually make more money than your 9-to-5. But don't quit your job just yet.
I quit!
Being employed may offer greater stability and security and less financial and legal responsibility. Then you have employment benefits, and your employer pays for a half of your CPP yearly contribution. Being self-employed means you pay for the full amount, and for 2025, the maximum annual self-employment contribution is over $8,000. Passive income. Not all income sources require the same amount of work. Some are more passive than others. An hourly job requires more hours for more income. Then there are income sources that keep generating income long after you put in the work. Examples include dividend income, phone farming, passive investing, crypto staking and mining, rental income, whether it's real estate or equipment, cashback credit cards and apps, and making music, books, stock photos, digital designs, and advertising on your vehicle. And really, you can make any business passive by outsourcing all the work, including someone to manage it. You're just a shareholder and receive the profits. Some businesses are more passive in nature, like an automated car wash, laundromat, storage units, parking lot, vending machines, and e-commerce. The average millionaire has 7 sources of income. Getting paid twice a month is no longer good enough. Increase your income sources to get paid more often. This will also help mitigate risks and provide more stability even when one income stream fluctuates. Have a mix of passive income and active income. Up next, banking. Banks or credit unions are essential for everyday spending, keeping your money safe, and giving out loans. However, not all banks are equal. With the right bank, you can avoid unnecessary costs, maximize savings, and make your money work for you. Checking accounts. All your income goes to this account, and all your spending comes from this account. Whether that's direct spending or using this account to pay bills like credit cards or utilities. Your average monthly fee for an unlimited transaction account is $17, while premium accounts are $30 a month. For the majority of people, these costs are unnecessary. Consider online-only banks like Tangerine or Simply, where they have unlimited transaction, no-fee accounts. I have been using both of them for over 10 years and don't miss a thing. The only reason you would need to pay for a checking account is if you have an incorporated business. as there are no fee options. Not yet anyway. If you do need a business checking account, you'll need to compare options and choose the right one based on transaction volume, convenience of physical location, and fees. If you are a sole proprietor business, a business checking account isn't necessary. Any separate no-fee checking account will do, waiving the monthly fee. If you hold a certain amount in your checking account, you can get the monthly fee waived, but at what cost? Do the math to see if you would end up ahead if you instead invest that money for a higher return. However, it's recommended to keep a buffer in your checking account to avoid going into overdraft. Saving accounts. Shop around and look for the best rates. Usually online banks offer the best rates, and you could even chase promotional rates. I personally switch between Simply and Tangerine for competitive promotional rates. Check out highinterestsavings.ca for the best high interest savings account rates and GIC rates. There is no need to have all your financial accounts at one bank. If you want the best of all worlds, multiple institutions is the way to go. Shop around for any loans. My Tangerine line of credit is interest only and 0% plus prime. Doesn't get any better. Shop around for credit cards. Your bank's credit card likely isn't the best bang for your buck. I personally use a combination of no-fee credit cards. Mainly the Rogers World Elite, Triangle World Elite, Tangerine World, and a Simply Visa for more cash back than I would get with an annual fee card. As for investing, stay away from the banks again as they have the highest fees. Consider brokerages like Wealthsimple, Questrade, or Interactive Brokers. For crypto, the best platforms to use are Newton, Wealthsimple, or Endax. And with crypto, you need to consider self-custody with hot wallets and cold wallets like Ledger. The next section of essential financial knowledge is credit. Start building your credit as early as possible once you feel responsible enough. Good credit is essential for building wealth as it's a way to leverage your money or raise capital. It may even be used for renting an apartment or getting a job. Getting a loan. Lenders don't just consider your credit score. They may also consider your credit history, debt to income ratio, employment, income stability, and collateral. Checking your credit score. Without damaging your credit, you can check your credit score for free with apps like Borrowell and Credit Karma. This will cover the two credit bureaus in Canada, Borrowell for Equifax and Credit Karma for TransUnion. Credit cards. A revolving credit, meaning you can reuse the credit again as you repay it. Using credit cards is the quickest way to increase your credit score by having a perfect payment history and by keeping utilization low. Secured credit cards. These cards are for individuals who have no credit or low credit and want to build their credit up. Credit cards are a double-edged sword. Credit cards are tools that provide many benefits like building credit, rewards, insurances, reservations, and many more. But credit cards, if not used correctly, can cause you to overspend, get you in debt, and destroy your credit and cost you thousands of dollars of interest.
I have $30,000 in credit card debt.
The grace period. This is how long you have after a purchase to pay the balance in full so you don't get charged any interest. The minimum and average grace period is 21 days. The average annual interest rate in Canada is 20%. This 20% is divided by each day in the year and then multiplied by your average daily balance during the month. To calculate this, get the annual interest rate and divide it by 365. Multiply that by your average daily balance, and then multiply that by days of the month. And that's how much interest you're being charged every month. Higher interest rates. Your interest rate will be higher for cash advances and even higher again if you miss the payment. And even one missed payment can be a quite significant drop on your credit score and will stay on your credit report for 6 years. Payday loans. This is your absolute last resort loan. With an annual interest rate of 365%, be prepared to be stuck in the debt trap if considering a payday loan. Buy now, pay later loans. This type of loan allows you to divvy up a purchase into multiple payments, often at 0% interest and without fees. But if you do happen to miss a payment, that's when the interest and fees start racking up. There is also a hidden danger.
I am not in danger, Skylar. I am the danger.
Thinking you have more money than you actually do. If you need to get into debt to make a purchase, you can't afford it. Secured and unsecured loans. A secured loan requires collateral like an asset and usually has a lower interest rate than an unsecured loan. This will be a mortgage, auto loan, home equity loan, or HELOC. A personal loan is typically a fixed amount given to you all at once with a fixed interest rate, with fixed payments, and once it's paid off, it's gone. This type of loan is considered an installment loan. A line of credit typically has a lower interest rate but isn't fixed, as it will fluctuate with the lender's prime rate. And this prime rate is influenced by the Bank of Canada's overnight rate. A line of credit is a more flexible borrowing option where you can withdraw funds as needed up to a certain limit. You only pay interest on the amount you use. As you repay, the credit becomes available again, similar to a credit card. RSP loans. These loans are specifically for investing in an RSP. Many factors should be considered with this loan, including income, financial goals, interest rate of loan, debt to income ratio, etc. Auto loans. Interest rates for auto loans can range from 0% up to 35% depending on your credit history and other factors. The average car loan interest rate is around 7%. New cars will usually offer lower interest rates than used cars. A down payment may also help achieving a lower interest rate. Financing can be available through the dealership or the bank. Shop around for the best interest rates yourself and take it to the dealership to see if they can either match it or beat the rate. The smaller your monthly payment and longer the term, the more interest you'll end up paying. Mortgages. When buying your first home, you can put as little as 5% down, but doing so means you will need to pay for private mortgage insurance, which can range from 2.8% to 4% of the home's value. If your down payment is 20% or more, you won't need to worry about private mortgage insurance. Fixed or variable mortgage. A variable mortgage rate is beneficial when interest rates are falling, but may cause your monthly payment to go up if the interest rates are rising. With a fixed mortgage, you may pay more in interest, but your payment amounts are consistent and there are no risk to your payment getting higher. As for loan term, in a low interest economy, the 5-year term is the most popular, but in a high interest economy, the 3-year term is preferred. As for amortization period, a longer amortization period results in smaller monthly payments, but more interest paid over the life of the mortgage. To pay off the mortgage quicker and with less interest, look at the accelerated mortgage payment, which means you pay weekly or bi-weekly, causing an additional payment each year. Another property. If you're looking to buy another property, 20% is required for a down payment unless you plan to live in it. If you do, you may only need to pay 5%. Student loans. Federal student loans in Canada are interest-free. Provincial student loan interest will depend on the province, with a handful not charging any interest. Business loans. A business loan is usually harder to be approved for as it has a higher interest rate and may require a business plan or previous year's tax returns or purchasing equipment as collateral. Options for business loans include the Canada Small Business Financing Program, local banks and credit unions, or BDC. If you want to take your financial knowledge to the next level, you'll need to understand investing. Saving alone won't make you wealthy. Investing will. Not to be confused with trading and gambling, investing's goal is to build wealth over time, so a consistent long-term approach is crucial. There are many different investments to consider. Let's begin with the stock market. If you're looking for a full beginner's guide on how to invest in the stock market, check out the video up here or look for the link in the video description below. But let's finish this video first. Time in the market beats trying to time the market. Statistics show that dollar cost averaging into the stock market will outperform trying to buy and sell at the right time. Most investors won't beat the market long term. This saying is referring to how actively managed funds and individual stock portfolios will not generate a higher return than the S&P 500 index consistently over the long term. The S&P 500. This is an index that tracks the stock performance of the 500 largest companies listed on the US stock exchange. The average return of this index is 10%, but will widely vary from year to year. Index funds and ETFs. These investment products are the easiest way for beginners to invest in the stock market with low risk. Bonds. Bonds are generally safer fixed income investments used to lower risk in an investment portfolio. Dividend stocks. These are stocks that provide passive income while growing your wealth. Mutual funds. An outdated investment with high fees. Instead, consider robo-advisors or all-in-one ETFs. Basically, a passive way to invest with minimal work. Precious metals. Gold is an asset for preserving wealth, not growing it. It won't make you rich. It's the better alternative to holding cash. And if you want all the benefits of gold or other precious metals like silver, you need to have it in the physical form, cryptocurrencies. Regarded as the most volatile asset market, crypto has the potential to lose all your money or return insane amounts. So never invest money you can't afford to lose. The least riskiest strategy would be to stick to the highest conviction coins like Bitcoin and Ethereum and hold for the long term. Bitcoin is digital money that allows people to send and receive payments without needing a bank. It operates on a decentralized network, meaning no single person or government controls it. It is also considered to be digital gold and serves as a hedge against inflation. Inflation is the rate at which the general price level of goods and services rises over time, reducing the purchasing power of money. And the number one cause of inflation is the increase in the money supply, meaning the government printing more money. Bitcoin, on the other hand, has a fixed supply. If you want to hedge against inflation or beat inflation, you need to hold less cash and hold more assets like stocks, precious metals, cryptocurrencies, or real estate. Ethereum, also a cryptocurrency like Bitcoin, but it can also power smart contracts, which are programs that run automatically without any intermediaries. Peer-to-peer loans. Platforms exist like GoPeer where you can loan money to others for interest. This is a great way to further diversify your portfolio with competitive returns. Other investments include private equity, hedge funds, and venture capital. These have the potential for higher returns and higher risk, but will require a bigger investment and is usually illiquid. Collectibles, controversially, can be also considered an investment. This can be anything from Pokemon cards to wine to fine art. Just be aware of this asset's other factors like fakes, damage, theft, and storage. Other assets that may not be considered investing but rather trading are derivatives like futures and options, commodities, and foreign currencies. Compound interest is the eighth wonder of the world. The longer you invest, the more time your interest earns interest, so your wealth can grow exponentially. Avoid panic selling and FOMO buying. Learn the rule of 72. Simply divide 72 by the expected annual rate of return, and this answer will be approximately the number of years it will take for you to double your money. Understand your risk tolerance. Higher risk can mean higher rewards, while lower risk can mean lower returns. Diversification reduces risk. Don't put all your eggs in one basket. This is why products like ETFs can be great investments. They can hold thousands of stocks all under one ticker symbol. Invest with a financial goal. When you're investing with a financial goal, you can correctly choose the right asset allocation. Asset allocation. This is how your portfolio is split up. A certain percent in equities like stocks and a certain percent in fixed income like bonds. Short-term goals, 1 to 3 years. Examples would be saving for an emergency fund, paying off credit card debt, or saving for a vacation. If you need your money sooner than later, assets like a high interest savings account, high interest savings ETF, or GICs will keep you safe while providing some kind of return.
Not much.
A high interest savings ETF is an ETF that pays interest as a dividend. And a GIC is like a savings account that usually has a fixed interest rate and is locked in for a period of time. Medium term goals, 4 to 10 years. This will be goals like saving for a down payment on a house or starting a business. This portfolio will be a mixture of equities and bonds depending on your personal situation. Long-term goals, over 10 years. This would be goals like retirement or your children's education. For long-term goals, an all-equity portfolio has the greatest potential for returns while giving you enough time to reduce risk. Whatever your financial goal is, just make sure it's smart, specific, measurable, achievable, relevant, and time-bound. Example, I want to save $60,000 for a down payment on a house. Based on my income and budget, I can realistically allocate $1,000 per month by reducing discretionary spending and increasing my side income. Owning a home is a key financial goal that aligns with my long-term plan for stability and investment. I will reach $60,000 in 5 years. If you want to learn more on how to set and achieve financial goals, check out the video up here or look for the link in the video description below. Real estate. There's 3 main ways to invest in real estate: buying and selling for appreciation, buying for rental properties, and REITs, which are publicly traded companies that own real estate. REITs are for someone who doesn't want to deal with the hassle of directly owning real estate. They are also easier to buy and sell and are much more affordable. Rental properties. Rental properties, on the other hand, are illiquid, require a bigger investment of money and time, and you may have to deal with nightmare tenants that eat into your profits. The benefit? Equity growth, appreciation, better tax benefits, and with a mortgage, you're using leverage to increase your total return. And for flipping houses, they have the potential for high returns in a short period of time, but have the highest time commitment and the highest risk level. Business. Building wealth through the stock market and real estate may be a long life process. If you want to leverage your money, skills, and time, a business can be the greatest return on investment. You can either buy an existing business or start up your own. Investing in an existing business can be less risky than starting from scratch, but you must do your homework to avoid buying a failing operation. If you're starting a business, once you do all your research, you'll need to pick a business structure. Sole proprietor, this means you and the business are one. So any income your business makes will be taxed with your taxes at your marginal tax rate. But business expenses can help reduce your overall income taxes. Corporation, the business and you are two separate entities, meaning any income the business makes is in the business and files a separate tax return. This means if you want to get paid, you need to pay yourself a salary or pay yourself dividends. A corporation is harder to set up, has higher costs, but lower tax rates, and limited liability protects owners from debts and legal action. Partnership. Basically like a sole proprietor business, but between two or more people. Next, you'll need to do a business name search and choose a business name, and register your business, and register for CRA accounts like payroll and GHT HST. Businesses must register and start charging GHT HST on its sales when it hits $30,000 in taxable sales in any 4 rolling calendar quarters. You'll need a separate checking account and savings account for your business to keep transactions separate from personal transactions. You may need a bookkeeper or do your own bookkeeping. You will need an accountant, especially if you're incorporated, and keep your receipts. If you want to start a business but don't know what business to start, begin with your hobby and explore the many different ways you can monetize it. The next section of this course is taxes, usually everyone's biggest expense.
Where's all your money gone, Daddy?
Taxes.
Taxes is not just your federal and provincial income tax, but it's also payroll taxes like CPP and EI, sales tax, carbon tax, sin tax on specific items like alcohol, cigarettes, and fuel, property taxes, land transfer taxes, capital gain taxes, and other fees that take money out of your pocket and into others, like toll roads, airline fees, vehicle registration and licensing, licenses to hunt, fish, cut wood, and carry firearms, environmental fees, and our new favorite tax, tariffs. Let's take a look at our income taxes. Your income tax rate will depend on how much taxable income you have and what province you live in. But there are ways to reduce your taxable income. Contributions to a RRSP or a FHSA. Any contributions are deducted from your taxable income, which will usually result in a more significant tax return. Other ways to reduce your taxable income include contributions to a spousal RRSP, an RPP, support payments made, moving expenses, childcare expenses, income splitting, tax loss harvesting, and the famous Smith maneuver. This is a strategy that allows your mortgage interest payments to become tax deductible by borrowing from your home equity to invest. You may also reduce your tax owing by tax credits. There are 2 types of tax credits. The first one is a non-refundable tax credit. This credit reduces your tax payable but cannot create a refund if the credit exceeds the amount of tax you owe. The other type is a refundable tax credit, which on the other hand can result in a refund even if you have no tax payable, meaning you can still receive money back from the government. Examples include basic personal amount, Canada employment amount, tuition tax credits, medical expenses, eligible dependents, HST, GHT credit, and the Canada Workers Benefit, tax sheltering and deferring. If you have an investment portfolio and use accounts like an RRSP, TFSA, RESP, and a FHSA, any capital gain in the accounts can grow tax-free. With the TFSA, any withdrawals can be taken out tax-free. With the RESP, there's a government grant up to $7,200. Principal residence exemption. This allows homeowners to sell their primary residence without paying capital gains tax on the profit as long as the property was their principal residence for every year they owned it. This exemption applies to 1 property per family unit at a time, and if the home was not a principal residence for the entire ownership period, Only a portion of the gain may be tax-free, the lifetime capital gains exemption. This allows individuals to sell certain qualified assets, such as shares in a qualified small business, and shelter up to $1 million in capital gains from taxes. This means that if you sell an eligible asset and make a profit, you won't have to pay capital gain tax on the exempt amount. The exemption is over a lifetime, meaning once you use it, the amount available decreases. Now, what if I told you taking out additional taxes from your check and getting a large tax return isn't ideal? All this means is you gave the government an interest-free loan. And what happens if an emergency happens and you need that money? You'll need to wait till tax season to get it back. Instead, consider putting additional money into a savings account where you can actually earn interest and access that money if needed. Form T1213, request to reduce tax deductions at source. If you actively know you'll be getting a large tax return from RRSPs or support payments, you can request to reduce the amount of tax withheld from your income throughout the year, which means larger paychecks and a smaller tax return. In other words, you'll have access to your money sooner, filing your income tax. If you have a simple tax situation, you can file your taxes for free using software like Wealthsimple Tax. And if you're up for it, this software can even handle more complicated tax situations like having a sole proprietor business. Seek an accountant for more complicated tax situations or for an incorporated business, but be prepared for the costs. Sales tax. Avoiding sales tax in Canada can be difficult, but there are many things to consider. Each province will either have HST or PST and GST, with the exception of Alberta and the territories only having GHT. Some items are zero rated, meaning there's no taxes, like essential groceries, prescription medication, medical devices, tuition fees, childcare services, children's goods, books, feminine hygiene products, bank fees, rent, used residential housing, and so on. Each province will have a different list on what's taxable and what's not. The best way to avoid paying sales tax is buying privately on Facebook Marketplace or Kijiji, or buying from a small supplier business that isn't registered to charge sales tax yet. If you're interested in learning how to pay less taxes, check out the video up here, or once you finish this video, look for the link in the video description below. The next section we will cover is insurance. Insurance is about protecting yourself from financial disaster, but depending on your situation, not all insurance is necessary. Whole life insurance isn't as good as it sounds. Unless you're a high net worth individual, term life insurance may be the better choice, as it can save you more money, which you can use to invest, which can outperform whole life insurance. Balance protection for credit cards. It may seem like a good idea, but this isn't the case for most people. It's expensive, difficult to claim, and just plain not worth it. Credit card insurances. One of the benefits of credit cards include insurances like common carrier accident insurance, mobile device insurance, event ticket protection, extended warranty, purchase security insurance, trip interruption or cancellation insurance, car rental collision insurance, lost baggage insurance, and many more. If your credit card has a lot of these insurances, you're likely paying for a premium credit card. But it is possible to get many of these different insurances with no annual fee cards. Renter's insurance. This type of insurance is only a fraction of the cost of house insurance and can not only protect you from fire, flood, and theft, but also liability. If something happens to the rental and you're at fault, you could be held liable. Home and auto insurance. Actually, all insurances. Make sure you read the fine print and actually understand what's covered and what's not. You may be paying for something you don't need, or even worse, you may think you're covered in a situation where you're not.
Sorry. This policy only covers actual losses, not made-up stuff.
Now, you can't make active income forever, and you probably don't want to. So you need to think about retirement. Don't leave yet, you'll want to hear this. Normal retirement is 60 to 70. However, you can retire at any age without pension if you have enough savings. How much is enough? Depends on your lifestyle and annual expenses. According to the FIRE movement, the rule of thumb is to save up at least 25 times your annual expenses. This is your FIRE number. Then you have the 4% rule. This refers to the idea that once this money is saved and invested, you should aim to withdraw 4% of your savings per year during retirement. At this rate, most retirees can keep up with their current quality of life. But in order to achieve this, you'll need to start early, save aggressively, like 50% or more of your income, have high income, and invest early. But even if you can't achieve this, some form of this plus a part-time job or small business may be enough to semi-retire. If early retirement isn't for you, let's look at some sources of income in retirement. CPP. Your CPP payments will depend on your earnings history, contributions, and what age you started receiving payments. You may receive CPP as early as 60, but each month you wait, your CPP will grow by 0.6% for a total of 36% more if you take it at 65. If you still don't take it at 65, your CPP will grow by 0.7% each month for a maximum of 42%. Consider that this income is taxable, so if you're still working at your job and getting CPP, you'll be taxed in a higher tax bracket. If you withdraw from your registered retirement account, that is also considered taxable income. Converting your RRSP or LIRA. A LIRA is similar to a RRSP, but locked in until retirement. A LIRA is an option if you leave a job with an employer-funded pension and want more control of the portfolio, more flexibility when withdrawing, but more responsibility. Once you do retire, your RRSP can be converted into a RIF and your LIRA can be converted into a LIF. These accounts are meant to provide you with a steady stream of income during retirement. And yes, this income is taxable. You may also be getting payments from a defined benefit pension plan or a defined contribution plan from your employer. A defined benefit pension plan guarantees you a fixed retirement income based on your salary and years of service, with the employer responsible for investment risk. A defined contribution pension plan depends on employee-employer contributions with retirement income based on investment performance, meaning the employee takes on the risk. Both are taxable income. Withdrawals from a TFSA or non-registered account isn't considered taxable income. Old age security. This is another government pension available once you hit 65, regardless of work history. The amount you receive depends on how long you've lived in Canada after 18, with 40 years of residency giving you the maximum benefit. And high income earners may face an OAS clawback, meaning reduced payments. And lastly, if you have low income due to no workplace pension, no RRSP, or low CPP payments, you may receive GIS included with your old age security. Now, everyone's personal situation is different, so it's recommended to seek professional advice from financial advisors, certified financial planners for retirement, and an accountant for business and tax planning. Make a will. Don't wait till you get old to make a will. Ideally, the earlier the better, even if you don't have many assets yet. A will is a legal document that specifies how a person's assets should be handled and distributed after their death. A will is important for naming beneficiaries of your assets. A beneficiary is a person designated to receive assets, benefits, or funds from a will, trust, insurance policy, or financial account after the owner's death. A trust is a legal arrangement where a person transfers assets to a trustee who manages them for the benefit of the beneficiaries according to the specific terms. This is so the beneficiary doesn't just sell all the assets and mismanages it. Successor holder. If you name a successor holder instead of a beneficiary for accounts like a TFSA, the account will remain open and continue to be sheltered from tax. If a beneficiary, they receive the assets, the account closes and the tax sheltering goes with it too. Bonus topic, your significant other. Like it or not, the partner you choose to be with will play a huge role in your financial success, as you will play a huge role in their financial success. This is because finances in a relationship are a team effort. Sharing income and expenses with a partner can help you achieve your shared financial goals quicker. A dual income household can provide more stability and flexibility if done correctly. Have you ever heard of the two income trap? The two income trap happens when households rely on both partners' income to maintain their lifestyles, leaving them more financially vulnerable than a one income household. As expenses rise, bigger mortgages, car payments, childcare, and lifestyle inflation, families become dependent on 2 paychecks just to cover the basics. If one income disappears due to job loss, illness, or a career break, financial strain can hit hard, leading to debt, stress, or even bankruptcy. The key to avoiding the trap is living on one income and saving or investing the second, so financial security isn't tied to both earners working indefinitely. So if done correctly, a dual income household can allow for higher savings rates, more investment opportunities, faster debt payoff, and more fun money. Now, what if one partner doesn't work? They can still contribute significantly to the household's financial success in many ways. Finance isn't just about income. As you can tell by all the topics in this video, there's tracking expenses, managing the budget, and making sure bills are paid on time, identifying areas to cut unnecessary expenses, and find ways to save more to stretch their income further. Cooking meals at home is a big one. Eating out can cost you thousands per year. Handling housework, childcare, raising kids, home maintenance, managing the investment accounts, handling financial paperwork, taxes, and strategic planning. And if you do have a business or want to start a business, income splitting can be a legal strategic move to minimize tax liability. One partner can create the product or offer the service, while the other partner does the bookkeeping, invoicing, marketing, customer service, managing social media accounts and websites, and handling phone calls. Subjectively, money is the leading cause of divorce. Financial strain like debt can put a lot of pressure on a marriage, especially when couples have different views on money management. Financial infidelity can erode trust and lead to a marriage breakdown. Couples that share the same views and values will likely have more long-term success. When choosing a partner, look for the red flags: excessive debt without a plan, bad spending habits, no financial goals, avoid money talks, and no financial responsibility. This is why it's important to have honest money conversations early. Communication is key. And
teamwork makes the dream work.
In today's society, money is still considered taboo. And it's because too many people tie their personal net worth and or identity to money. Money is just a tool. So learn how to use it correctly, and one day you'll be financially secure and stable and be able to fulfill all your financial goals, pass down generational wealth, and or retire early. For sources to increase your financial knowledge, use books, podcasts, courses, programs, social media, blogs, newsletters, apps, financial tools, people, real-world experiences, and of course, YouTube. Browse through my other uploads for any topics you want to learn more detail about, or watch one of the videos on the right of the screen. See you there.